Hey, what's happening, Skyview? It's Christos, and we're here on June 5th, 2017. Another pretty boring day in the SPY. You can see we're largely unchanged here, down around 0.06%. We did have a little sell off to start the morning, but bulls quickly bought that dip, broke us over to new highs, and then we kind of just traded back down towards the open. And as you can see, we're largely unchanged for the day so far. The VIX still looking pretty pathetic, under 10 in this 9 handle here, so not much going on with volatility in the market. No fear really creeping back in just yet. We are around that 45-day to expiration range in the July cycle, so we do want to get some more positions on. So if we just take a look at kind of what we already got here, I did somewhat scan this stock watch list, and the problem is, there are things to do, but there is a lot of these tickers that really only have $5 wide spreads, $5 wide strikes. And we already do have a few of those on. We've got this Apple trade on that's doing okay, up a little bit there. Baba doing okay, up a little bit there. Both $5 wide Condors. Facebook again sitting at around break even, but another $5 wide Condor there. KRE, we were able to trade this one a little smaller, only 4 points wide, which is nice. Microsoft has to do another 5-point wide condor there. So we already have a lot of these 5-point wide condors. And again, with the VIX, in the 9 handle under 10, it's just our personal preference to want to be trading a little bit smaller in these times. But unfortunately, especially early on in the cycles, all you're going to get is those $5 wide strikes, especially for a lot of the things that we like to trade every cycle, like the Apples and the Facebooks of the world and stuff like that. So it is kind of tough to find a spread under $5 wide if you want to trade it. One thing I noticed is that we don't have a position in gold in here. And gold is one of those things that we like to trade every cycle. Gold, bonds, SPY, oil. These are things that kind of run the market or are the market. And we just like to have a position in them every cycle. So we do not have a gold position. For gold, there's usually two underlines that we like to trade. One is GLD, a little higher priced, $120 underlying. And you can see IVRs here at 15, 25, and 33. And the other is GDX, which is a little smaller of a underlying, only a $22 underlying. And you can see IVR in here is 0, 0, and 1 across the board. So very low IVR in GDX. Because of that, it makes me want to go to GLD, right? Just a little bit higher IVR in there. So why not choose that one over GDX? You can pretty much do whatever you want in here as far as if you want to do an Iron Condor or an Iron Fly. But GDX, because it is that lower price underlying, it's kind of hard to construct Iron Condors in here. Usually we do some type of Iron Fly. But we're not even looking at GDX today. We're just going to look at GLD. So why don't we go ahead and take a look at the option chain. Go to GLD. And GLD does have dollar wide strikes, so we can make this either a $3 or a $4 wide condor. Let's first see if we can get something like a $3 wide to stick. If not, and we're not collecting enough credit, then maybe we can widen out the strikes a little bit. But let's just try to go as small as we can here. And again, we just saw our IVR and gold a little bit on the lower end, so it doesn't make sense to trade smaller even from that regard as well. So as far as starting with short strikes, I'm usually around that 30 delta or dollar pricing mark. That kind of brings us to this 119, 120 here, I guess. And let's go with the 119 and sell that, right? And then we'll just go 3 points wide, and that brings us to 116. 116 is here at the 11 delta, so right in my wheelhouse there. So we'll go over here. Click on the ask there, And you can see we're collecting around 50 cents here for the vertical on the put side. So we'll go to the call side and see if we can collect around another 50 cents. And going to around that 30 delta dollar mark brings us right here at this 124, 125 area. And why don't we just short the 125? And then going 3 points wide from there brings us to 128. And that looks like it's going to collect another 50 cents. Perfect. And that brings us up over $1 credit there. So if we're collecting around $1 credit on a 3-point wide spread, we're collecting about a third of the spread's width. And that in turn gives us a 67% probability of profit. That's just how the math works out for that. So this is right in our wheelhouse here, and I kind of like it. Short the 125, short the 119. I always just like to give the chart a quick look, kind of see what I'm working with here. 125 brings us up here, and then the 119 kind of brings us right around here. So that's something I'm pretty good with. Why don't we go ahead and route the order and let it sit there while we kind of draw some price slices on the chart. Usually a very tight spread between the bid and the ask here are the nat and the mid price. Did I not do what I wanted to do? There we go, confirm and send. And then we'll edit it here. And you see a very, very tight spread, only 2 cents wide. So of course we're going right in at the mid price, see if we can get a fill. And it does not look like we're getting the fill, but that's all right. We'll just let that sit there because it is such a tight spread. We'll draw some of our price slices on the chart. Again, short the 125 and the 119. So if we wanted to just go to the chart, and of course I'll have a little pop-up that you can skip this if you'd like. I'll try to do this as quick as possible. I need the right tool first. So 125 is here. And the 119 would be around here. And 3 points wide brings us to 116, which is here. And then 3 points wide from 125 brings us to that 128 area, which is here. Perfect. So this would be our max profit area anywhere within this box right here. And then of course our max loss areas are anything below our long put here at 116 and anything above our long call at 128. Because we're collecting around $1 for this trade, we can just add $1 to our short call. Our short call is at 125. If you add $1, it brings us to 126, and that would be around our break even to the upside. And then same type of thing on the bottom. Our short put is at 119. If we subtract $1, which is the credit we're receiving for the full spread, if we subtract $1 from 119, that brings us to 118 or around 118, and that would be around our break even to the downside here. So we're basically just looking for GLD to stay largely neutral, maybe get a little contraction and volatility, and that should generate a nice win for us a few weeks down the line. If not, we will just be patient with our loser per usual, and as we're approaching that expiration week, we'll be looking for just some type of directional luck to kind of put us back into our sweet spot and back onto the dance floor of our Iron Condor range. That is if we had not been able to manage a winner and we are down on the position heading into that expiration week. You guys know we like to stay patient with our losers, and we do so just in hopes that we might get some type of directional luck, because on these defined risk trades, when it's around expiration week and we're around our max loss, we're pretty much down as much as we can lose on the position already. We're kind of around our max loss point. So what we look for in those situations like that is a little directional luck to kind of pop us back into our range or pop us down into our range wherever we are. And at that point, we feel like we have much more to gain than we have to lose. And that is why we stay patient with our losers heading into that last week or two of expiration. So that's about it on this one, but we are still not even filled on it. So it looks like the mid going down on us. Maybe it's around 101 now, and we're in at 102. So let's go ahead and cancel, replace the order. Still around there, spread widened about a cent. Let's go down to 101, see if we can get a fill here. Does not look like 101 is going to fill us either. Well, let's just sit there for a second, maybe check out the SPY one more time. Close this. Not much going on, down around 0.08% now, so I guess accelerating to the downside, but not really, right? We're kind of going nowhere. A couple of days last week with these larger volume bars than we've kind of been accustomed to. Volume's been very, very light lately. That's kind of what happens. In the beginning of the summer, we have a couple holidays, a couple long weekends, summer trading coming into play, so volume tends to be a little bit lighter. But that does not mean we can just take off for the beach every day, right? We still have to stay active, taking off positions, putting on positions, and that's what we are trying to do here, but not quite having any luck. So let's see if we cancel replace one more time. Maybe get filled at $1. I'm sure it'll fill us here. And this is why trading tight liquid spreads is really so important, guys, because we are going to get filled somewhere between this NAT and this mid price, right? And usually the more volume and open interest, the closer to the mid price that we can get filled. But even if there's not a lot or just not a lot of volume and open interest on that particular day that we are trading the underlying, well, we know worst case scenario, we'll get filled at the NAT price. And as long as we have a tight spread, then it's really not the biggest deal in the world, right? And not to mention, it's easy to exit when we do want to exit. You know, a lot of the times on these e-liquid options, you might be able to get filled, you know, a couple cents off the mid price when there's a 20-cent spread. But then when you're trying to get out of the position, you're not going to get filled at the mid price. You're going to have to go all the way to the NAT price to get a fill. And while you didn't give up too many dollars on the way in, you'll likely give up a lot of dollars on the way out. So that's just something you kind of learn as you experiment with different tickers, and you kind of find the tickers that you personally like to trade, and you tend to remember the ones that kind of gave you trouble on the way in or on the way out, and maybe you kind of stay away from those. That doesn't mean there's not money to be made in those tickers. It just means it adds a little extra stress when you're kind of fighting for a price to get in or out at, right? Still not filled at 101 here though, so maybe we will go down to $1. And this dollar should hopefully fill us. Nope. Oh, perfect. Just filled there at $1. So that's about it for this video, guys. You can see it here in our filled orders now, and right here in our position statement. We already kind of went over what we're looking for on the chart here in gold, and we have the price slices up, so we will be able to come back to this when we do close the position and see how it has played out. So that's about it for this video, guys. Thank you for listening. I hope you learned something from it, and until the next video, take care.